Well, we've been talking about this rally. We've been waiting to see to try to get off of that low point from earlier in this month, up to a 5% number potentially, or up to moving averages, and that process was looking good, especially on Monday this week, where we gapped up big post expiration, options expiration up to the upside. But then we've stalled the last couple of days. Now the question is again, have we peaked, and are we now rolling over to new lows? Or are we still in this process of working our way up to the upside? So I'm going to break down just how bearish we have been the last couple of days, what it means, how likely we are to continue lower. What are the chances that we still get those signals, those patterns of failure that we've been talking about? Do we still expect it to fail? Are we starting to get a better move in terms of like breadth and sector rotation that can really help us get up to new highs and break through these averages and get up to new highs? So we'll break all that down. Our sector rotation, big moves in the dollar, big moves in gold. What does that mean to this idea of risk appetite? The sector rotation is telling us we only had one sector last 2 days underperforming the market. You can probably pretty much guess what that is. But we've had one sector really start to kill it, and it's not energy. Energy's been the biggest winner since that low point earlier this month. But energy has not been the big winner the last 2 days. We'll break down what those winners were and what does it tell us with this kind of 2 day sector rotation. What does it tell us about what how tenuous this market sentiment is and how likely we are to again fail, because that's the big question. How likely are we to fail and to move to lower lows and below the 200-day? So that's going to be the main topic of today's discussion, and our trade idea in that one area, in that area that's doing so well, is where our trade idea for the video comes from today. So let's go ahead and get started. Today is Thursday, March the 27th, 2025. This is the market outlook from marketscholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at marketscholars.com for free. Follow me on Twitter for more content between the videos. And join our Market Outlook Facebook group that we've created. All right, if you're watching here on our blog, check out some of these other things over here on the right, including our Market Outlook live videos where I take a look at old Market Outlook trades, see whether we should stay in them or get out of them. We actually got out of a couple today. We also put on today's trade already before the market closed. Come down to the bottom, click this heart. It opens up this tab. Hit that like button there. Same thing here. Click this thumbs up icon. It opens up this tab. Hit that like button. Again, the more you do that, it helps get our content out to all of our followers on these platforms. So thank you to those who do this day in, day out. Those who don't, you can do it right now while you're watching with one or two really easy clicks. Help us get over our goal, get back to 100. We've been in the hundreds. We've been working our way back up. It's our first time in the 60s. So now our goal is to get back to the 70s. All right, let's start off taking a look at the S&P 500 with the market forecast indicators. You can see we did have a continuation of the drop, but very small range. Again, much smaller than what we saw yesterday. So I don't think there's a whole lot more to this little move. You can see the momentum line actually just finished slightly in the reversal zone there at 19. The near-term line also finished slightly in the reversal zone. Excuse me, at 19 as well. So oversold short-term sentiment, but barely oversold, and I think an opportunity for that near-term line now to bounce, and momentum line for that matter also, to bounce out of these oversold levels back up to the upside, especially the momentum line. Usually doesn't stay down here for very long. So I think there's a good opportunity for us to bounce. Like, I don't think we're done going to the upside. We've been talking about this 5%, expecting a 5% move. We still don't have it yet. We got up to 4.6, I believe. I think 4.86 on the close at the highs, but at the closing there, 4.6%. We're only at 3.11% right now. But you can see, because of these last couple of days, as we've been taking some time to get this, the moving average has really come down. So what would have taken a much bigger move to get a bear tag being a close above the moving average, so light green shading, as long as the intermediate line is below the chart's midpoint. So light green shading as well as a yellow line means we're closing above a falling moving average. So that's a bear tag, and usually you get those on these failed rallies. Again, we only need to get to 57.97 to get to a 5% gain on a closing basis, right? On a closing basis, 57.97. Well, this moving average is getting progressively closer to 57.97 itself. So, on the move that we get, that 5% rally, probably will get to that 30-day. Now, the 50-day is a little bit higher than that. We'll see here in just a second. I'll show you in a second. But at least the bear tag, at least the 30-day is kind of what you need to see to say, okay, now we're done. We fit, potentially, now we're at the point where we can fail, and then we'll see what ends up happening there. So that's what the S&P did today. The NASDAQ 100, you notice, looks very similar. A little bit more oversold in the short-term sentiment. The near-term line crossing below the intermediate line with, again, the intermediate line between the reversal zones. So a little bearish in that perspective. But again, we didn't really follow up with a strong move on yesterday's decline. So I expect that we'll bounce here pretty quickly as we came down on that really bullish near-term high point that we had. If we take a look at the Dow Jones Industrial Average, you can see again, we actually did get a lot closer to the 30-day average there. The short-term sentiment is not as bad as yesterday. We didn't have as big of a drop, and today not as big either. Your near-term line is in the reversal zone, so now we look for a bounce, right? Now we'll look for a bounce back up above 40, and we'll see how bullish that bounce ends up being. And then finally, your Russell 2000, very similar, oversold. Short-term sentiment crossing below the intermediate line. Its intermediate line is actually slightly above the market sentiment line, but only slightly, and probably won't last very much longer there. Still in bearish territory, both of them. Remember, the Russell 2000 is in correction. So it's already had its pullback. It's already had the failure. See, this is the bear tag that we're waiting to see that the S&P gets. It's very similar to what we saw back in 2021, 2022. So, we failed. We got the bear tag here in December on the Russell 2000, the end of December, very beginning of the year. Well, that was when the S&P was hitting all-time highs. So pretty darn similar to what we're seeing now. So you can see in that end of, right here, the end of December, that move where the Russell was forming a bear tag and failing, that was when the S&P was getting to all-time highs. And you see that here, again, that move that we got right here on the Russell 2000, the move here that we just got the bear tag on back in January 21st and then a little bit after. Well, if you look at the S&P on January 21st, so right in this area right here, like we also got a bear tag, but then it went up to all-time highs and a cluster no less. So and the Russell was failing here and then rolled over to lower lows. So the Russell, it's just almost exactly like the end of 21-22, where the Russell has formed the pullback and the failed bounce and the bear tag, and then the drop to new lows, and the S&P is just now doing that. And so we're expecting to see a similar pattern now on the S&P like we did in early 2022. Right, we didn't quite get the bear tag, but came pretty close. We did get light green shading in the yellow line, except we were below a rising moving average. That's why it was yellow, and that's why you don't see a bear tag there. We have to be above it for us to actually get that. And we came close there, but we were dark pink shading instead of light green, which we got the next day. And so you came pretty close. So you got the idea that failed bounce at the moving average, the intermediate line not getting above market sentiment, and we roll over to new lows. Right, so the same thing that we saw in the Russell 2000, we finally did get on the S&P, and it looks like we're potentially getting that now at the intermediate line again, still below market sentiment. I think we got one last near-term rally on this move before we fail, if we fail, of course, right? But I expect that we will. Again, we have to anticipate that we're going to go up to new highs because 85-90% of the time we do. There are a lot of factors that suggest that this time we won't, but that doesn't mean, again, 85-90% includes all those other times that we didn't. So still pretty high odds that will bounce up to new highs. But even if we don't, I think we got one more near-term rally to the upside to get to those signals I just told you about before we ultimately fail and move back below the 200-day moving average, move to lower lows, and then we start our extended run below the 200-day moving average, which is what a correction is, right? And again, that's a process that takes months to form the low and then bounce back up to new highs. It takes months to get back up to new highs there. It only takes weeks on pullback. So if this is a pullback, it's already been taking weeks since this hype, since we've started to do this. It's taken a little too long, as you'll see here when we look at the Ichimoku cloud. That's why, again, I think that's probably not just a pullback. If we take a look at the crossover chart again, nice little transition candle. The problem is it's not a bullish transition candle. You notice the actual candle itself is not very bullish there. So it's not really a great reversal transition from this bearish move. Usually when you get transition candles that are not reversals, they tend to be the continuation. So that would mean that maybe after another transition candle or two, that we ultimately continue the bearishness, especially considering they're right on that 40-week exponential, and that the gap has really dropped. It's dropped after spending a lot of time above 5%. It's dropped back below 5%. That's the key level for that drop there. Let's take a look at the 3 green arrows. Of course, we have 2 greens. The MACD histogram is falling. I think, again, like I said, I think we got one more last hurrah up to the upside before we really fall. But we do have 2 greens. We don't have 3 greens anywhere because we're not above the moving average yet, and that's usually when you get your bear tag, is when you get those 3 green arrows. Let's take a look at the 2-line version of this. Again, we are still below the 200-day. We actually dropped back below the 8-day today and back below the point of control. You can see the MACD, as bearish as it is. Stochastics and the MACD are both above their moving averages, but MACD is still below 0. And Stochastics actually is in bullish territory down there. If I take a look at some of the other oscillators like the DMI, we're still above 25 on the negative indicator. We're still below 20 on the positive. So, we've really recovered, but obviously not enough to change the trend to the upside. If I look at the RSI and the CCI, again, we are flirting with getting above 50. We never did. We're not below 40, but we're not above 50 yet either. So I need to actually continue to push this to today. And then, of course, the CCI is, did not get above the 150 level, which is kind of what you need to see if we're going to, get the escape velocity that we need to get off of a low point and change the sentiment. Now, if I look at the Ichimoku cloud, again, that pink shading is coming up. We need to be above that pink shading by the time we get to the pink shading in terms of price to feel really good. And you can see there's here's the rate of change. We need that rate of change to turn positive, which means it's got to cross through that level. If we start to get, by the time we get to this low point, if the rate of change is back below, because remember this red line is the current low point plotted backwards by 26 days. So from the low point, we kind of got 26 days to get above the cloud and to stay up, and to cross through this line. If we get to 26 days and the red line is below this low and we are below the pink cloud, then we are, again, that's what happened in 2022. If you look at this move over here, you can see, by the time we got to the pink shading, we were below it. And by the time the red line got to the pullback low, we had already come back down and we're to lower low. So it never actually crossed through that line right there. It stayed below the lows because we were to new lows 26 days forward. And that's the issue that we're getting now. It's like, are we going to be the new lows by the time we get to 26 days from March 13th, 26 trading sessions, right? We still have a very mature bearish trend down here that you don't get mature trends on even on over here on the 2023 drop, we had a mature trend for we never did get a mature trend because we never did get below -5 over here, and we were barely above 80 for a couple of days. We've been above mature trending levels for a while. Again, that's last time we saw that for an extended run was during that 2022 level where we had a pretty bearish run there, and of course in June that's when it really hit the fan. At the end of May we had that strong run, then we had another strong run in October at the end of that low point. So it's not common at all to have a bearish intermediate, a mature bearish run. It's more common for the bullish moves, but not very common for the bearish moves. But that's how bearish this move has been, and again, likely that it's not just a garden variety pullback there. Finally, looking at your Bollinger Bands and your Keltner channels, you can see we're right at the point of control. We're right, the Bollinger Bandwidth is declining. It's actually moved back inside of the bandwidth. The momentum has really lightened up. It's still bearish, but it's way less than what it was. And we are not, we spent a couple of days in the upper half of the bandwidth. We're still in the lower half, not in the lowest quartile. but we're still in the lower half there, so we're still not necessarily out of the woods here. When you look at today's intraday range, we had a lower high and a lower low. We closed at the low, at yesterday's low. We didn't quite close below it after actually opening below it this morning. We filled in the gap pretty quickly, but that filled in the rest of the gap from Monday. So now we can consider that filled in. But so I think now we can bounce, right? I thought that was a common gap. We filled it in. Now I think we can bounce up for another couple of days. We are still, when you look at where we are in the 4-week range, and that 4-week range is kind of tightening up a little bit because the highs are starting to come down. The beginning of the 4-week range is starting to come down these highs, but we are still in the bearish levels, so we're below 40. And we need to get above 60 and really kind of get above 80 and 90, kind of really break out to stay at this bullish level. And obviously we are not there. This has not been a strong enough of a bullish move, and probably won't be. We probably might be flirting with 60 at the 5% mark and the bear tag mark, and probably nothing less than that. And that would contribute to the failure. Again, looking back a few years to the last correction over here, you can see that when we did get up and flirted with 60, but never could really stay above it, and we broke right back down, and away we went to the downside. So that's kind of what I'm talking about there. Let's take a look at today's range and volumes. They were both relatively below average, 42 million shares trading hands, 6-point range. So those are both below average. So you're starting to get a little bit of a peak in both the ATR down here at the bottom, normalize up here at the top, and then the volume there in the middle. Again, that's bullish whenever those are falling, but we need to get more. We're still below moving averages, so we're still due some big moves, and so I don't think we're necessarily done, and we're going to break down and really get going here. And same thing with the VIX. The VIX is relatively low itself, right? It's below 20, it's below the 95% mark, but has not gotten below the 90% mark. And the other thing too is your VVIX is still right there at 90. That's a pretty low level for the volatility of the VIX, the implied volatility levels of the VIX. So with your VIX sitting on, at relatively lows there, I mean, it really can't go too much lower without actually breaking through and now trend, if it breaks through 90, if it breaks through 15, it breaks through 90, breaks through 90% would be over here relative to the VIX 3M, and breaks 90 here on the VVIX. If it breaks those levels, and for that matter, also breaking the 200-day moving average on this chart, then now we're in a bullish trend. That's bullish for risk appetite. So we're kind of sitting at those levels. I think obviously there might be a little bit more downside to the VIX, a little bit more as we make that last hurrah, that last near-term run to the upside to get to the 5% mark and the bear tag. I don't think it will fall very much because I think we're kind of holding here and susceptible to a leg higher on volatility, and that's kind of what I'm expecting going into at least into the middle of this next expiration cycle, if not closer to April expiration. All right, now let's take a look at what's driving this price action here today. So let's just move into the asset class comparison chart. Look at that move on gold over the last 3 months of 16%. Developed market, emerging markets just absolutely destroying U.S. equities over the past 3 months. That trend continuing. Let's look at just today. Look at that move on gold. A lot of its weakness in the dollar. Let's take a look here really quick at the weakness in the dollar here. So let me just bring up this other chart first. Let's do this one here. So the dollar's been flirting with its 200-day moving average. I tried to get back above the 70 and did yesterday, but a big break back down today. Now again, one day doesn't change things and give us this little bear flag, but yeah, it's kind of looking similar to the equity market right now in terms of trying to get to that 30-day moving average and potentially failing. If you take a look at the euro, which is the biggest component of that dollar index, it's pulled back to the 200-day after breaking up through with a good bullish move to the upside. Got below the 17-day, and we'll see how much of a return, how much of a move we have up here. Without necessarily getting all the way down to the 30-day moving average. Of course, That means that gold is just going like gangbusters up to the upside. You can see it just continues on this very strong parabolic move that it's on. That's been on, like it's had multiple parabolic moves here lately. You can see like it had a run right there. It's making a new run right now. It had this run on the positive DMI. If I look at the gold contracts, we don't have as many gaps in it. You can see this was going up to its highest level, this current move, and is approaching into the mid 30s again, which is about as high as this gets. Sometimes, I mean, it did back last year. This time it got up above 40, but it's a very, very strong move and very low negative indicator on the DMI, very high, relatively high positive indicator. And that ADX again is running up above 20, as close to getting up above 25. So very strong trend. In fact, if I look at the trend strength indicators for GLD, I mean, look at that. I mean, this is about as mature as we've seen here with the up to 14 on the trend quality index, which we were higher over there. But, you know, again, from in terms of length of time, you can see how, you know, another mature bullish run. We've had 3 mature bullish runs since the beginning of 2024, and that's why GLD, in this case, GLD has gone from 189 up to 281, so up 100 points. In fact, if I look at the weekly version of this, you can see that run on a weekly basis. It kind of started over here where we crossed up above 50 and crossed up above 1 on the week of February the 26th. A strong move up to highs, and then we just blasted off to the upside again to the point where we have a pretty mature bullish trend going on here. If you look at, you know, the last good bullish move that we had in gold was back in 2019, going into and through COVID there, into the worst of the COVID. It was the last time we had this bullish run that ultimately ended, and we just kind of went sideways, and here we are again. So very strong move, and the difference between this time and some of these other times, here let's get up to the, let's see, where is it? Let's see here. So let's go to stock charts, and then we'll go to the ratio chart is what we want to see. And here, let's refresh that page with the ratio. And let's take a look at gold to SPY. I mean, again, like you can see just how strong. Look at that 50 to 200. Like, zoom out so we can see some more context here. Let's go all the way out so we can see more context on just how strong this long-term PPO is. Right? It's, you know, last time we were here was during COVID when we had this strong of a move. It's one of our stronger moves. 2011 was another time. Like, we are clearly kind of going parabolic here, and you know, again, the correlation's pretty negative when gold is outperforming stocks. That's not necessarily a bullish thing for equities, but you can see like we've broken the 200-day moving average. Now let's take a look at the weekly version, because this is a little bit more telling. We have broken above the 200-week moving average and up to new highs on a relative basis. Again, you can see how strong that PPO is here, one of the stronger levels, again, outside of COVID and outside of 2011 with the credit crisis that we've seen. You know, where the 50 is about to cross the 200 here, as you can see with the exponential charts. You can see the big bullish move on the DMI, on the CCI, and then up here on the RSI getting above 70. Like, very, very strong rally. And you can see too that the correlations actually turned positive over the past, in this case, 63 weeks. Again, very rare for that to be the case, and ultimately will turn back down to its normal negative correlation. And if we start a new bullish trend to the upside, as you would expect, considering, you know, we have clearly broken up above the 200-week moving average, and the 8 and 17 and the 30s, the 50 is crossing. Like, we are clearly starting a new trend, similar to what we did with COVID. But this has been a little bit more, like that was like a one big spurt over a few weeks, and then we're right back down. That's not the case this go around. It's been a lot more protracted, as you can see, a lot more protracted, and has more potential of actually staying. And of course, if it stays and this falls back to a negative correlation, again, that would be a negative for equities. So a lot's being said about gold being at all-time highs and going parabolic, but the reality is it's very oversold relative to equities. And what's interesting is that bonds are very oversold relative to gold. So you can see like gold's been very bullish. Bonds have been dropping like a rock to gold is still down there to extreme lows on a relative basis on the long-term basis here. So you have a very, very good margin of safety right now in long-term bonds, again, on a relative basis to the precious metal. So gold will continue to do well in a correction, or excuse me, won't, like, if the correction starts, gold will probably end up peaking, not necessarily relative to equities, but in this case, probably relative to, a very parabolic move here in its ratio with bonds. And that will make bonds, even if bonds don't necessarily go skyrocketing to the upside, and gold doesn't continue to go up either, but it will make bonds a very good alternative to buying gold, which is, like I said, already at such an extreme high point there. Again, because of that weakness in the dollar. That weakness in the dollar, again, I wouldn't expect that to be the case going forward for an extended period of time. Because it's usually the dollar ends up doing pretty well during a correction. All right, let's take a look at the 10-year yield and see what it's doing here. So let's go back to a daily chart on this one. Again, kind of ramping back up. So we had a bearish trend on this. It's gone now. We are back up above some moving averages here. Had a pretty good run. Here's 10-year yield. Back above the 30-day average, now kind of flirting with the 50. Again, I think we're right in the midpoint of 4.25% to 4.5%. I think this is probably around the peak. I don't think the 10-year yield has a very good opportunity to run up to the upside. I think it's more likely to end up failing back down to the downside. And if I look at their correlation right now of bonds relative to equities, you can see. So if bonds and bond yields and equities have a negative correlation, so they both turn lower, they have a positive correlation, that means bonds and stocks would have a negative correlation. You can kind of see that that's been the case here lately. It's been the case quite a bit here lately. In fact, if I take a look at, sorry, not this one. If I take a look at, not this one either. How about this one? The 3-month correlation, not just the 2-week. It's been a pretty positive correlation, but you can see it's turned negative over the last 3 months. And so, again, if that negative correlation continues, which is kind of the norm in a deflationary environment, then that means yields and bonds are moving in the same direction. And that would mean that yields most likely are going to end up themselves failing at these important moving averages, in this case the 50-day moving average, and itself working its way back down below its 200-day moving average for another extended period of time like we had back in last fall, late summer into early last fall 2024, when the market pretty much was pricing in the rate cuts. And then once we got the cuts, you can see on September the 18th, we immediately started going higher. So it started pricing out any potential rate cuts going forward. So it priced in as much as it could, getting down to 3.66%, but we ended up pretty much only going down to right here. And so the market rallied, or the 10-year yield rallied because because the market was taking out the extended run of rate cuts and ended up being just a little bit of a mid-cycle adjustment at the end there. We are moving into an important period of time for the end of this month. Like, we have broken below the 10% mark on the rate of change, the 12-month rate of change. When you've been above the 10% mark and you break below it, that typically means we're having more than just a pullback. Also, when you have an all-time high 1 month and then the next month you fall 10% to a low point below the 12-month simple moving average, then it sets us up for a correction as well. And then, depending upon where we close, the last few bear markets, so 2008, 2001 to 2003, 73, 74, and then 69, 70. Those are the last kind of major bear markets that the market has had. We've had a little one in 77, 78, a little one in 81, 82. Those were minor because their valuations were already so low when those bear markets started. that they didn't have much to lose. There wasn't much to reset. But the valuations were higher at 69. They were higher in the mid 70s. They were higher, obviously, the last two bear markets that we had. But every one of those bear markets, we actually closed back up above the 12-month moving average at the end on this month. And so we are a 0.5% away. So really important day tomorrow, really important day on Monday, right? Those are our last 2 days of the month. If we close below it, ironically, then usually it's just led to a correction and nothing more, as we've seen plenty of examples. I tweeted out the list of all the corrections where we had the all-time high 1 month and then we closed below the 12-month moving average after a 10% drop the next month. But in this case, we're kind of flirting with closing up above it, which, like I said, in the last so many instances has led to more than just a correction. Again, very early stages. It takes months for a correction to develop. It takes months for a bear market to even start. From the all-time high to the start of a bear market, it can take 5-6 months for that to happen. So we still are long, if in the worst case scenario, we are a long way out. But again, getting the Copic curve turning red here on the monthly chart, dropping below 10% after having been above it for quite a while, dropping below the 12-month moving average, and potentially closing below it here this month. I mean, those are all signs that we are probably going to be in this period of volatility here for a while. The breadth also suggests that. You can see the breadth continues to not be very strong in this rally. It's actually negative again today. It's still below zero on the summation index. The money flow is not supporting the rally. We saw that the sector rotation is not supporting the rally. We continue to not be led higher by energy, and that's not the move that we want to see on a bullish move to the upside. You can see XOK and XOK had a brief period where it was outperforming. The last 2 days just getting hammered. In fact, let's just look at the last 2 days. Here, 3, 26, and 27. XOK down 3%. And then in fact, it's the only sector underperforming the markets. XOK and XLY and XLC are pretty close, so down 1.5%. But you can see staples up 2.5%. Utilities, real estate. I mean, it just goes to show how quick the market is ready to go back to safety on this sector rotation move. How quick it is to go back to safety here. So we aren't necessarily in a risk-on trade. They're moving down to the left, but they're not. They're starting to kind of slow that descent. And XOK and XOY, which are looking really good, is starting to now maybe not be so bullish up to the upside. And of course, the weekly trend shows a clear move into safety trades as well as these other cyclical areas that are not bullish with risk appetite when they outperform the markets here, especially considering the current sector weighting disparities that are very much in favor of XLK and to a lesser degree XLY and XLC. And that brings us to our trade idea of the day. It's actually in that consumer staple space. Here, let's go to the market forecast chart first, and that is on Dollar General. Dollar General, Dollar Tree have both been doing really well here. Dollar General getting a cluster, so the intermediate line is just crossing back above the 80th percentile. And usually when you get that move with a cluster right at the start, that usually cements a pretty good bullish trend in development. So I like that oversold cluster or overbought cluster there. If you notice you can see a really good bullish pattern there. If you look at the weekly chart, you see a nice, in fact, let's take a look at the weekly market forecast here really quick. I skipped that. Pull that up here, Dollar General, and we'll take a look at the 5-year weekly. Again, you can see we have just turned dark green line, and we're that close to getting some. We've got green shading. We got a bear tag last week. We're building on it here this week. So I think we have a really good development here. The near-term line well up into reversal zone extreme highs. The near intermediate line crossing above market sentiment. So I like this setup. This is what it looks like now on this chart here. You can see lots of bullish candles in a row, a higher Heikin-Ashi close. The PPO is rising, pretty good sized bullish candles down there at the bottom. Obviously, we have 3 green arrows on this chart, and you can see we are getting closer to or above the point of control. We're kind of breaking out above some highs, multi-week highs today. We're getting closer to that 200-day moving average, and if and when we get there, we're at the top of the value area. There's not very much volume, because once we get into this gap here, there's very little volume that we can push through. This is on the daily chart, no less. So a good move higher is what it looks like on the weekly chart, again breaking above the 30-week and making its way into this gap to the 50-week or potentially beyond. So a good opportunity for a good move to the upside. You can see if I look at the DMI, it's got a bullish breakout pattern here above 30 on the positive indicator, way below 20 on the negative. If I look at the RSI and the CCI, they're both clearly at bullish levels, have been above 60 for a while. It's been back above 100. In fact, if you look at the weekly version, we crossed above 100 a couple weeks ago right here on the week of March the 10th, and we're now up to 200 on the CCI. So very strong trend change, which you kind of need because we've been so bearish for so long. We're above the cloud. We're on the cusp of a mature bullish trend forming here. The rate of change is clearly positive. And then you look at the Bollinger Bands. We're in the upper quartile of the band width that's rising, and we are above the upper Keltner channel with some pretty positive momentum. So with that being said, I wanted to give myself some opportunity here for some decent return, but not necessarily in that, I don't want a short-term move. I want to be able to let this thing kind of work. So I bought the at-the-money call option, which was closer to actually at the money at the time we did this during the Market Outlook Live. Put a 50% stop order, and you can see with about a $500 risk, ultimately, if I get stopped at the 50%, then in a 1 standard deviation move to May expiration, we're looking at about a 4-to-1 reward to risk ratio with a potential $2,000 gain. Obviously, we'd probably be rolling it but before now and then. But that's a pretty good return for, again, a small amount of risk if the stock continues on this move that it's been developing here. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen that takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread. Let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on the video. Join us at MarketScholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your Thursday night, everybody, and we'll see you all next time.